The market loves confidence, but it punishes fear. And nowhere is that clearer than when retail traders obsess over protecting their capital. You've been told countless times, always use tight stop losses, never risk more than 1 to 2% of your account, trade small. On the surface, it sounds smart, safe, responsible. But here's the harsh truth. Obsessing over safety doesn't make you safer. It makes you predictable. And predictable traders are the easiest prey for smart money. Every twitch of fear, every rigid rule you follow, every micro adjustment you make to avoid losses is being observed, measured, and exploited. You think you're cautious. They think you're a target. Imagine Sarah, a retail trader from Ohio. Every night she studies charts, sets precise stop losses, waits for perfect setups, and believes she is doing all the right things. She's convinced she's protecting her account. But every time she enters a trade, the market nudges just enough to hit her tight stop loss, then reverses violently in the direction she anticipated. Frustrated, she blames bad luck. Yet it's not luck. She's predictable. Her fear and overprotection are visible, like a neon sign screaming, "Liquidity available here." Smart money doesn't need to guess what she will do. They orchestrate small moves to trigger exactly that behavior. Every textbook and webinar emphasizes capital preservation, stop losses, risk percentages, small positions, all seemingly logical. But this conditioning creates a crowd that is predictable, cautious, and reactive. Smart money doesn't fight this crowd, they harvest it. Tight stops and small positions become markers. Here's where retail panic will hit. Here's where liquidity sits. The market is not punishing risk, it's punishing predictable fear. Picture a stock consolidating for weeks. Retail traders obsess over where to place their stops. Smart money watches quietly. They nudge price slightly below obvious support levels. Stops trigger. Panic sells cascade in. Insider buyers quietly accumulate. Then, when liquidity is fully harvested, price surges. The retail crowd who believed they were safe becomes the fuel for the next rally. Safety, in this context, is a trap. Consider Tesla during a volatile week in late 2021. Retail traders piled in, setting tight stops near obvious swing lows. Hedge funds engineered subtle dips to trigger these stops. Panic selling occurred, liquidity flowed to the insiders, and the stock then bounced back sharply. Retail traders, thinking they had been cautious, were manipulated. Their overprotection was exploited. Now expand this to forex. Your USD trades within a tight range. Retail traders set stops just below support. Smart money nudges price down, triggering stops. Liquidity is absorbed. Then price rockets upward, contrary to retail expectations. Fear-driven exits become the very engine of insider moves. Cryptocurrency markets amplify this pattern. Bitcoin consolidates. Retail traders place tight stops near support. Whales engineer micro dips, absorbing retail orders, and then push the price higher. Fear-based exits are collected as liquidity to create momentum. Every predictable move is exploited. The market doesn't punish risk. It punishes fear and predictability. The irony is brutal. The more rules you follow for capital protection, the more visible you become. Tight stops, micro position sizing, waiting for perfect setups, all of it makes you a beacon. Smart money doesn't need to act randomly. They only need to engineer scenarios to trigger your predictable moves. Fear becomes a magnet. Here's the psychological layer. Every time retail traders see a breakout or dip, the first thought is, will I lose? This fear triggers small, tight stop-loss placement. Then, when small manipulations occur, the retail crowd exits. Insiders quietly accumulate, confident they've triggered the crowd's behavior. The rules designed to protect capital feed the very traps they're meant to prevent. Think about consolidation zones. Retail traders obsess over every minor swing low or high. Smart money nudges price into stop-loss clusters. Liquidity is harvested. Then, the market reverses dramatically. The retail crowd, believing in safety, is trapped. This is not hypothetical. It happens daily across stocks, forex, commodities, and crypto. Even in volatile sectors like meme stocks or highly shorted names, the same behavior repeats. Retail traders, overly cautious and fearful, set tight stops around support or resistance levels. Price is pushed to trigger them. Panic selling occurs. Smart money buys quietly. Once liquidity is absorbed, the trend continues, leaving the retail trader disoriented. Safety, as taught, becomes predictability exploited. So how should traders respond? First, awareness. Understand that your stops, your rigid rules, your obsession with risk can all be exploited. Second, context. Don't place stops blindly. Consider liquidity zones, market structure, and who benefits from your trade. Third, psychological independence. Learn to observe price objectively without fear-based reactions. Reacting to every tick or minor pullback invites exploitation. Visualize a trader analyzing a consolidation. Instead of panicking at minor dips, they study liquidity zones, market sentiment, and volume clusters. Only when the broader context aligns do they act. Their stops are not arbitrary. They are strategically placed with an understanding of how insiders might manipulate the market. They are less predictable, less exploitable, more in control. Every retail panic is a story of predictable behavior being harvested. Tight stop losses, rigid rules, micro-position sizing, fear of loss, all make you visible. Smart money thrives on this visibility. To protect your capital truly, you must understand human psychology, liquidity, and market behavior, not just memorize safe trading rules. Observe real-world examples. Stocks consolidating for weeks, then small dips trigger retail panic. Liquidity flows to insiders. Forex pairs quietly accumulate before triggering stop hunts. Cryptocurrencies see whales create minor dips to collect retail liquidity, then explode. Patterns repeat. The market does not punish risk, it punishes fear, predictability, and overprotection. So, the mantra of capital protection must evolve. It's not tight stops and micro risk alone. It's understanding context, psychology, liquidity, and timing. True protection comes from patience, awareness, and strategic execution. Predictable fear is the enemy. Invisibility, strategic patience, and alignment with broader market currents is your shield. Next time you think, I must protect my capital at all costs, remember, the market sees it as a signal. Every stop loss, every cautious entry, every overprotective rule. It's not just a shield, it's a beacon. Smart money reads it, exploits it, and uses it to fuel their next move. To survive and thrive, learn to think contextually, act strategically, and understand the psychology of the crowd. Safety without awareness is the most visible trap of all. And if this opened your eyes even a little, subscribe, hit like, and check out my other videos breaking down smart money tactics, hidden liquidity traps, and real-world market manipulations, so you stop being the predictable trader everyone else profits from. And here's the kicker. The more you obsess over protecting your capital, the more the market reads you like an open book. Every micro stop loss, every cautious entry, every little hesitation screams predictable behavior. Smart money doesn't need to guess. They already know where your stops are clustered, where fear is strongest, and how to exploit it. They engineer tiny dips, just enough to trigger panic, just enough to harvest liquidity, and then reverse the market for massive moves in their favor. Think about it like a chess game. You're moving your pawns carefully, thinking you're safe. Meanwhile, the grandmasters are setting traps, luring your pieces into positions where they can capture them easily. Your safe moves? Exactly where they want you. And that's the harsh reality. In markets, playing safe without understanding the bigger game makes you prey, not a survivor.